All right, so I do like to start off the show as usual with just commentary about what's happening with the stock market. This is actually one of the more popular areas right now. It's just the thought process of what's going on. This has been a really interesting year. Got a chart here of the S&P 500 so far year to date, and you can see what's happened. That red line shows kind of the overall trend, which has been down. Had a couple of challenges to that trend line, both of which failed, but now we're down back right at this low that we established back in June, and that's really critical. This is the critical point in the market so far, in my opinion, and we're really kind of watching for what's going to happen here. But on the news side, and this is kind of interesting, this just came out today, is what they call the PCE price index. So the PCE stands for Personal Consumption Expenditure, and this is the favored version of the inflation numbers that the Federal Reserve uses. So most of us are familiar with CPI, and that's what we're used to hearing about. The Federal Reserve pays attention to CPI, but when they're targeting inflation, they're looking at PCE. And so that just came out today for August. PCE comes out pretty late. It's a month later, kind of the end of the month for the month prior. And so it doesn't get as much attention, but it's actually more important than the other, inflation numbers because the Fed pays the most attention to it. So this, you can see on this pattern here right now, PCE dropped to 6.25% for the month of August, and we hit a peak there in June, okay? So not bad. We'd like to see things come down and what have you. But the main focus for the Federal Reserve is not the overall PCE index, which we're looking at here, but what they call the core index. And that's where they take out food and energy. And so here's where the problem lies. So core had actually grew last month. And you can see, it kind of peaked out back in March, and then it jumped again in June, but it's coming back up. I'd say the overall trend is still down, but even this 1 month movement upward makes the market very nervous because it means the Federal Reserve might have to push harder and harder. And certainly it's the wrong direction. Mm-hmm. I mean, if this month would have been down, okay, great. We had that one, blip in June, and we're just going down, 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 down. The market's probably doing pretty well in that environment, mm-hmm. right? So that's what's happening here is we've got this sticky inflation. We saw the CPI number actually go up more than expected for August also. And so this is what's kind of driving the market. The Fed is being very, very aggressive in their projections for what they're going to do, their wording for what they're going to do, and very aggressive actually in raising rates. So they're, 3/4 of a point 3 times in a row is pretty amazing. So, and that's creating some problems for the market. But I get back to kind of the big story here, which is this S&P 500 chart. To me, this is the key issue for what's happening right now. We can look at inflation, we can look at all the reasons for things that are happening. If you really want to pay attention to what's going on to the market right now, you have to pay attention to this chart because we've had this, basically 24% downturn on the S&P 500 from the high that was established way back at the very beginning. And one of the things that happens here is now this could be, okay, this is really important to understand. What the market's doing right now could be the sign of a reversal back up, break through that 200-day moving average you see there, that blue line, and reestablish a new uptrend. Retesting lows is often something that happens. And so the low that was set back in June, we're retesting that right now. And so really, there's nothing wrong with what's happened here. Even though we don't like to see the ups and downs and what have you, this could be a really good place. The problem is that we're seeing some signs that the testing of that low is kind of breaking down. First of all, we did break through that low, mm-hmm. But it's more of a zone, right? So that's okay to break through it a little. But Wednesday was really fascinating because Wednesday the market really jumped upward. It came down to that low and really moved. And it was 6 stocks up for every one down that day. Really good day. There should have been some follow through, 2, 3, 4 days, maybe that takes a rest and then continues to go. That would have been, that kind of breadth, that thing that we look for, that volume and jumping. we had that for that day. And so it was looking good, see what happens. But then the next day it failed and gave it all back. And today we're hitting, lows again. And so, we'll see. I don't know that we're going to know everything until next week, maybe. We'll see what happens. It's okay where we are right now is almost like a no man's land. Now, we did start back in August 30th to start to reduce the exposure that we have to the stock and bond market, mainly because we kept getting triggers to sell and didn't have triggers to buy anything else in replacement. And so we just kept moving that money into T-bills and ultra short-term bonds, because that's actually a fairly rare environment. Usually you have it says to sell this, and we find some other triggers to buy these other things. We have a very disciplined system as far as that goes, and we're not getting any buys. So that's kind of another warning sign to me that things could be a little bit hairy here. And so we continued to get those pieces out of the market over this time frame, basically over the month. I mean, August 30th is now 9:30. So, and then last Thursday, one of those sell signals we took and we pushed that, instead of into T-bills and ultra short-term bonds, we put that into the inverse, the ProShares short S&P 500 inverse goes the opposite direction of the S&P 500, ticker symbol is SH. And we're up almost 4% on that now since last Thursday, which isn't a huge rate of return, but not terrible for a little bit over a week.
Yep.
But even better considering that the market's down roughly about 4% since then. Again, it's one thing to go the opposite direction of the market. It's another thing to capture that gain and get back in. So, we'll talk about some of the buy signals and things that came up as a question this week too. But one of the things that is just critical to understand here is when I talk about being on the edge of the cliff and packing the parachute and all that, this is the cliff right here. Because past this point, let's say the market breaks through here, basically we have to start all over. The whole bottoming process just ended if we get through this. And now we're still looking for that bottom. And, someplace below where we are now, and then we'll need to see that big stretch, usually some kind of bounce, some kind of breadth coming back. And we start off with a new bottoming process. So now, again, for clients of ours, for the most part, our models are in T-bills and ultra short-term bonds, which are doing, okay in this environment. They're not falling as, like the stock market is here, that's for sure. And then we have an inverse position. And yesterday we added to that inverse position just based on some of the negative things that I saw happening in the market. And we, not a lot, but we bought some of the ProShares short Dow. So it shorts the Dow index. We added that yesterday. So anyway, those are pieces happening. We'll have to see what's going on. But this is kind of a critical period of time to watch. Again, for our clients, we're already out of the market. We're actually making money when the market goes down. And again, I know that sounds very strange, but that's kind of where we're at right now. And we'll have to see, kind of how that plays out. We still do have exposure to the market with clients that have legacy positions, clients that have positions that we purchased long ago with big capital gains. So there's still some, exposure on both sides for the firm as a whole. So every one of our clients might have a slightly different experience. But the models, which is where most of our money is, are currently in an inverse position, which is unusual for us, that's for sure. But this particular cliff is concerning to me because the next support level that I see below this is about 11% below, and there really isn't much support in between. I'm sure it'll stop someplace and make some runs and what have you, but you could get into a cascading fall situation, and that's what I want to be really careful of. So I hope things turn around. I hope this is the bottom. I hope that we start to see some buying come in. I hope that we see, inflation coming down, and the Fed starting to talk more reasonably about that. But, one of the problems we have right now is with this type of pressure, with rates coming up, with the dollar coming up, it exposes the world to more potential problems. It's this type of environment where we had WorldCom and Enron and Lehman Brothers and Bear Stearns. When you raise rates and you have this type of tight liquidity, those things that are on the edge, well, Greenspan's saying, I love it, right? When the tide goes out, you get to see who's swimming naked. The tide is out. right now, and let's see if that creates some real problems or not, right? It could be a country, it could be, a company, it could be, anything. Usually the biggest, scariest ones are the ones that we aren't even talking about, right? Those are the ones that cause problems. I'm not saying that's going to happen, but it's more likely and more pressure on those situations because of what has happened so far, right? So that's why you want that parachute. That's why you want to be cautious here. I'm usually completely optimistic. This entire channel was actually started off optimism, but this is basically like a 2008 type downturn. You just got to be careful that we don't end up in the downdraft all the way to the bottom as far as that goes. So anyway, that's what we've got going so far, and look forward to kind of talking to you again about this next week. Again, if you're my clients and our clients here at the firm, rest easy. We're actually well positioned for what's happening right now, and we'll keep you up to date as to what we're doing and how we're making those changes. But overall, I think things are just something to watch right now. We're just waiting. Kind of the same message we had last week. We just hasn't resolved itself yet. All right. Thank you very much.